Good evening. Welcome to our Sac State Alumni Association workshop, homebuyer workshop, I should say. My name is Jason Maida. It's great to be with everyone this evening. Thank you so much for taking your time out of your busy schedules to join us on a Wednesday evening. For those of you in Sacramento, it's a little bit hot today, right? So, it's probably good to be indoors, listening to a little bit of video content today. Really happy that you got a chance to join us. This is going to be just about an hour-long session. Is a very interactive video workshop. So we would encourage you to ask us questions as we go through tonight's content. We can use the Q&A feature or even the chat function within Zoom, and I'll answer those questions for you on air. My colleague Ken will also be kind of helping manage some of the chat there. So feel free to ask us any questions that you have. We create this class just to help educate our local communities in home ownership and just to kind of help guide you on that path towards home ownership. And this information is going to be something that hopefully will allow you those resources to be able to help understand if home ownership is a path for you, and we'll certainly be a partner for you in that journey. This information that we share with you tonight, we're going to be sending everything back out to you tomorrow. So since you've signed up for tonight's class, all the presentation material will be sent back out to you. We're also recording tonight's class. So this will be up on our YouTube channel. So if you have to step away for a second, this will be recorded, and you'll be able to kind of look back at some of the stuff as well as some of your notes. Now, a little bit about myself. My name is Jason. I will be your presenter this evening, and I'm the branch manager of American Pacific Mortgage here locally. It's nice to be able to teach a class here locally because we actually teach classes like this all throughout the country. So probably many of you that are joining tonight's class are right here in Sacramento. So we are based out of downtown Sacramento on J and 9th Street, if you're familiar with that. American Pacific Mortgage is a Sacramento-based company as well. We're the 9th largest lender in the country, and our team here within Sacramento is proud to be the top lending team within APM. So we love helping educate first-time buyers in home ownership. We do that through this educational platform. We do a lot of work with first-time buyers, and so that's why this educational platform really works to help connect the dots for first-time buyers on that path towards home ownership. Well, here's what we're kind of going to talk about tonight. We're going to look a little bit at the housing market, what's going on locally and abroad. We'll also talk a little bit about interest rates and kind of the movement that we've seen in the interest rate market and how that can impact buying power for you. We're also going to do a budgeting exercise in the next couple minutes. So I want to kind of compare what does renting look like versus what it could look like as a potential homeowner. We'll also talk a little bit about credit and preparing to buy. What are some things that I should be aware of as I'm thinking about, preparing for home ownership and getting qualified. We'll also talk about loan programs that are available to you as first-time buyers, or maybe even second or third-time buyers. So some of the loan terminology that'll be helpful for you on this journey. We'll also talk a little bit about savings for home ownership. What are some of the things that I can put in place to help prepare myself to have down payment funds or maybe closing costs available for me when I decide to purchase a home? And then we'll talk a little bit about first-time home buyer programs. Since most of our audience tonight is based out of California, we're going to talk a little bit about the CalHFA assistance program, some of those resources that are available to you as a first-time buyer here in the state. We'll then going to transition into looking at the buying process. So after tonight's class, you may want to learn a little bit more about what does home ownership look like for me and how do I take those next steps? We're going to walk you through the milestones of home ownership. So after the class, I say, okay, how do we get connected for a consultation? We'll kind of show you what the format looks like for a consultation, how we design home buying plans for you, and then go through the milestones of actually getting towards ownership of your home. And then we'll kind of finish up our class by doing some Q&A, but also talking a little bit about what a consultation looks like for you on that path towards home ownership. All right. Okay, well, let's talk a little bit about does buying make sense for me in home ownership? Now, this is probably going to be one of the biggest financial decisions you decide to make. So whenever that time comes and you want to pursue home ownership, it is a big financial decision. And clearly, with the audience that we have joining us tonight, you're taking time out of your busy schedules on a Wednesday evening to learn a little bit more about home ownership. So you understand the importance of making a great, sound financial decision. And when we think about home ownership, there's a lot of great benefits that can come along with home ownership. So for those of us that are renting today, when we decide to renew our lease, that landlord's probably going to ask for a higher lease payment, maybe a longer term of my lease. And, so I don't really have a lot of control on my housing budget, right? Well, as a homeowner, I'm kind of controlling more of a fixed payment as I make my mortgage payment, both for the loan I have as well as the taxes and insurance for my home. And when we think about buying in today's market right now, which we'll talk a little bit later tonight, it's an elevated interest rate market, but there are opportunities for clients to refinance down the road to help improve what that payment might look like and create better affordability for ourselves as existing homeowners. Now, this is an asset that should grow in wealth over time. And so as my home purchase price, let's say I buy it at a $400,000 purchase price, as that home grows in value, as I continue to pay down the balance of my mortgage, that creates home equity for myself. And for most families across the country, that's their number one asset that they have. So home ownership is clearly an important part of potentially creating generational wealth for families across the country. Now, there can also be some tax benefits that can come along with home ownership, potential tax deductibility of interest, as well as other tax benefits that could come along with maybe energy efficient upgrades that I make to my home. So when we think about home ownership, I always encourage our classes to think about it in terms of this is an investment that will hopefully appreciate over time. And it's not necessarily an apples to apples comparison. So when we think about renting and maybe paying somebody else's mortgage, right, versus having ownership of my own, I can reap the benefits that come along with home ownership. And to kind of illustrate that a little bit further, I want to walk our class through a rent versus buying calculator, just so we can kind of understand a little bit more about what does it look like if I consider homeownership? What are the benefits that are going to come along for homeownership? So we're going to transition to, I'm going to kind of open up our browser here and walk you through a calculator. Again, this is our rent versus buying calculator. For those of you that kind of joined a little bit late, again, we're going to send out all of our presentation material to you tomorrow morning, and we are recording tonight's class. So I'm going to walk you through the calculator function right now, just so you can get a handle of it and just give you kind of a what if scenario here. But this is a really useful tool to kind of frame up for you really what the benefits could be of owning a house today versus what it looks like continuing to go down the path of renting. So in our scenario here that you can see on screen here, we have someone assuming that they're paying about $22.50 in rent right now. We also make the assumption of a renter's insurance cost of $15 a month, and that their rent will increase 3% on an annualized basis. For some of us that are renting today, that number might even be a little bit bigger, depending on what area of the country or state or city that you're renting in. And then we make an assumption around the home purchase price that we're looking at. So we just put an average price here of about $450,000. We have a minimum down payment investment of 3%, which is on a conventional loan. We're going to learn a little bit more about the conventional loan product just a little bit later in tonight's class, but that is the minimum down payment as a first-time buyer. We have expected property taxes for my house at a $450,000 purchase price. We have homeowners insurance costs, which can vary based upon what location I'm going to purchase, specifically in California. If I'm in a foothills area, I might be in a fire zone, so that insurance might be a little bit more expensive, or maybe I'm going to purchase in the Natomas area that has a flood zone, and which would require flood insurance. So that can vary a little bit, but we'll put a baseline number of $1,500. We have maintenance costs for my home that we want to factor into our budget. And then we want to take a look at loan information. So what type of loan am I going to do? Well, most of our first-time buyers will do 30-year fixed mortgage. So that means the payments are fixed for a duration of 30 years. They can certainly pay that off quicker if they'd like to, but it's fixed for 30 years. We have an average interest rate. We'll put 6.8% for today's rate. We're going to talk a little bit more about that in tonight's class. And then we have origination charges. So that's what a lender will charge you for obtaining your financing through them. Now, because we're doing this class for our Sac State Alumni and Athletics Partnership, we actually discount our services for Sac State. We actually discount our services by $750 just to make sure your financing options are a little bit more affordable for you as a member of the Alumni and Athletics Association. And then there's discount points as well that are elective for buyers, which basically if you as a buyer want to bring down that interest rate, you can pay more funds out of pocket to basically create a lower rate level for yourself. So generally 1 point is the equivalent of 1% of my loan amount. And then that 1% that I pay out of pocket, so let's say it equates to $4,000 in real cost, that will generally bring down my rate about 0.25%. Now, we don't generally recommend clients make those investments today, and especially in today's market, because many of our clients buying today, because that we are at elevated interest rate levels, will probably consider refinancing in the next maybe 1 to 2 years. However, when we make investments like discount points, the break-even point is about 3 to 4 years. So we really don't recommend taking out those type of expenses in today's market. Now, the last section here in this component of the scenario is, what do other settlement services look like? And we call those closing costs, around title and escrow fees, maybe some of the local county charges or taxes, I should say. Those all get kind of wound into what closing costs would be for my home purchase. So when we think about savings, and we'll cover this in tonight's class, when we think about what we're going to save for home ownership, we have to consider what the down payment's going to be, which could be 3% of the purchase price, plus closing costs and prepaid items, which I generally coach clients to budget for about 2 to 3% of their purchase price for those expenses. Last section is other assumptions. We're going to assume that our home can appreciate on a 4% on an annual basis. We have expected years of renting or owning for 7 years. So we'll do that side-by-side comparison. We have the cost of selling my home one day in this market. We have state and federal tax rates, and then we compare that with a 1% savings rate. Right? Now, we all know savings rates are a little bit higher, but we're just kind of looking at over time. So when we side-by-side compare renting versus owning, our rent payment today is around $2,200 a month. It is going to jump significantly in a home ownership. So I'm going from $2,200 a month to $3,900 a month. So there's a $1,700 increase. However, and this is kind of where we look at the clear comparison of when we factor in the benefits of owning today versus renting, and factoring in tax deductibility of interest, appreciation rates potentially in my home, I have about a $62,000 opportunity of owning versus continuing down that path of renting. And that's kind of really the big opportunity for potential buyers, is to really understand, like, what does this look like for me to be able to enter in today's market? Well, it might not be as affordable from an interest rate perspective, but long-term, what is the upside for me in home ownership? Now, I would encourage our class to take some time when you get your presentation material tomorrow to maybe run your own calculation. I think you'll find that to be a really great experience to really understand what home ownership could potentially look like for me when I add in all the benefits of owning. Now, as we kind of build our budget, we want to think now a little bit about, what does the housing market look like right now for me, right? Is there opportunities for me to enter today's housing market? Well, let's talk a little bit about the housing market, because right now we're in the spring buying season, and soon enough we'll be in the summer buying season. Of course, today's temperatures almost feel like we're in the summer buying season, but ultimately, spring and summer buying season are the most active times, if you will, in the course of the year for home buying. And the reason why that is because more buyers are coming active in the market, because maybe, we're seeing warmer weather out there. So it prompts people to be more active in looking at homes. Sellers are more apt to put their homes on the market. So we see a lot more activity levels out in the market. What's interesting right now is we're seeing inventory levels start to elevate in the Sacramento market and abroad. We're seeing it across the country. Inventory is up year over year, 33%. And that's been one of our bigger challenges in the marketplace, is we just haven't had the inventory to support buyer demand. So I was reading an article earlier today, which, we're seeing kind of a backlog of inventory right now. And then generally Memorial Day weekend brings more sellers to put homes on the market. And so we may see, more market shift, if you will. So more inventory kind of stacking up, which the reason I point this out to our class is because we haven't seen this kind of inventory increase in the marketplace, and it is creating better supply for our buyers and more opportunities for our buyers. And so we are seeing a little bit less competition out there, because let's face it, we do have some uncertain economic times right now. So, those buyers that are financially fit and ready to enter today's market, there may be an opportunity given the supply that we're seeing in today's market. And so, when we look at the Sacramento market specifically, you can see kind of the median sales price at 510. That market price is up a little bit, but we're seeing a little bit of a flattening here, which is good. We obviously want to have better affordability for our local community. The other thing that we're seeing in the market and it's really important for buyers, is that 44% of all transactions, so almost half of all transactions being done across the country, include some type of seller concession, meaning the seller has taken a price reduction or has conceded credits towards buyers' closing costs. And that's a big deal in today's market. We see it firsthand with a lot of our clients where there's a lot more negotiating happening versus maybe what we saw a year or 2 years ago, even in an elevated interest rate market. So I do think there's some encouraging signs for buyers out there, especially from a supply perspective. Now, it might not be ideal from an interest rate perspective, and we're going to talk about rates right now, but the entry point to home ownership is really centered around the price of home, because ultimately interest rates change over time. And for buyers that can afford to get in today's market, there may be an opportunity to refinance down the road. Now, let's talk a little bit about where interest rates are at today. So interest rates unfortunately had a bit of a negative move today, so they went up slightly. Average interest rate across the country has been about 6.9 to 7%. We kind of inched a little bit higher, all kind of centered around, we had some government auctions that didn't perform as well. They had a C rating today, which had a negative influence to interest rates. We've also seen the U.S. debt being downgraded by Moody's, so that's also put some headwinds into the financial markets. So the Dow Jones lost, I think, 800 points today, but we also saw interest rates lift upwards. So wasn't a great day from a rates perspective, but it's kind of the volatility that unfortunately we've seen in the interest rate market. So where we're at today in interest rates, we're probably going to remain at elevated levels. But we're really watching closely what's going on with inflation indicators, because the reason why we're here in today's market is because inflation has risen and the Federal Reserve has lifted the federal funds rate to try to combat inflation. Now, there's two mandates for the Federal Reserve to hopefully bring down interest rates and in turn see our borrowing costs decrease as well. And that's to achieve 2% inflation. So we're trying to get to that level. Right now, we're about 2.5 to 2.6. depending on what report you look at, and then also look at the stability of the labor markets. So, we're watching economic indicators really closely, because that ultimately, as we see softening in inflation, interest rates will fall. Now, just one thing I just want to note for the class is that when you hear in the news that the federal funds rate is going to be cut, and we're probably not going to see it next month, but eventually they will cut rates, that doesn't necessarily translate to a direct correlation to mortgage rates, but mortgage rates will follow suit, but it will positively impact credit card rates, personal loans, lines of credit, things of that nature. But it also, like I said, spills into mortgage interest rates. So this is a look at the last 12 months, which if we look at the last 20 years, rates are very similar going back into 20 years ago. So, but of course, home prices were at a fraction of the cost we see today. Interest rates, as we kind of project out a little bit further into 2025, I think will remain at these levels. We may dip down to the mid sixes. I think we probably won't see interest rates fall below 6, potentially into 2026. But, it's a little bit of a kind of a back and forth right now with, again, uncertain things happening in the economy. Do we have tariffs? Do we not have tariffs? Right now we're in a 90-day pause, I guess, with tariffs. So we'll have to see what happens if there's any implementation of that and what the kind of the lagging impact is into the economy. But obviously we're watching things really carefully for our clients that are pursuing home ownership, because ultimately we want to try to attract the lowest interest rate option that's available in the market. Now, it's important to understand as buyers that interest rates are not the same for all buyers. It really depends on the timing of which they're buying, but also has factors around credit score and product eligibility, the type of loan program that they're going to elect, what their down payment might look like. So if I'm putting 3% down versus 20% down, that can change what my interest rate might look like. We talked earlier about discount points. So if I decide to pay additional funds out of pocket to bring down my interest rate, that could create more expenses, but also could potentially decrease my interest rate. And generally, if I shorten my term, so traditionally we do a 30-year fixed mortgage, but if I shorten my term to 20 or 15 years, or maybe even 10 years, that can also bring with it a lower interest rate. However, higher payment, but lower interest rate. As we get a chance to meet with our clients in the community, we're going to figure out the right design for their financing. We had that as part of our home buyers consultation, because everybody's in different financial situations and has different goals around home ownership. And that's why a consultation is so important to help design the right options. And in that consultation, we kind of sort through the different product matches, but what those interest rates look like for those different products. Now, one of the major kind of influences within interest rate is credit. And so in our classes that we teach, we like to kind of dive a little bit closer into credit to help you best prepare for home buying and to understand maybe some areas of opportunity within your own credit score. Now, every product does have a minimum credit score attached to it, and we've kind of spotlighted a few of the programs here. So we're going to talk about these programs specifically, but they each have a minimum credit score. The lowest credit score for entry to most product is 580. That is through our FHA or Federal Housing Administration product. You can see the other products that have minimum credit scores attached as well. Now, when we think about credit, there are three different agencies, as we're all well aware of, right? There's Experian, Equifax, and TransUnion. There are three different models to credit scoring. So there's credit card model, which is going to be most of the modeling that you see for some of your consumer monitoring services that you might elect, like Credit Karma, some stuff like that. There's also a auto credit score or auto credit scoring model, which is going to look at auto financing. And there's mortgage scoring model. So of course, when you're looking at home financing, we're going to use the mortgage model, which can have different factors in it, and which we're going to review in tonight's class that might look a little bit different. So one of the things when you're looking at your consumer model as a credit card score versus mortgage, we might see some variance in there, but of course that consumer model that you have, it still gives you great visibility to kind of what's going on with your credit score. Now, when we think about credit scores, each credit agency is going to have a different score. We always look at the middle score of all three agency scores. So if my highest score is 760, let's say my middle score is 740, and my lowest score is 720. In financing, we're going to take that 740 score to determine eligibility and just product selection and maybe interest rate options. Now, if I have a partner that may join me on the application, we have to look at the partner score as well. So if my partner's at 720, 700, and 680, well, my partner score is 700, which is the lowest middle score between the two of us. So when we think about qualifying for our product, as a lender, we're going to look at the lowest score, which would be 700 in this scenario, okay? Now, the impact of items on your credit score, like delinquencies or major events on your credit score, will generally be in the most recent 12 to 24 months. As we move further and further away from events that are negatively impacting my credit score, I should start to see improvement in my credit score. Now, if you've had negative items on your credit score or credit report, these are some of the kind of the timelines, if you will, in this matrix of how long they'll stay with your credit report. Now, they'll have that impression on your credit report for this timeline. However, the impact is generally in the most recent 12 to 24 months from the date of the event. So if I had let's say a late payment in October of 24 on a student loan payment, now I'm still within 12 months, so I'm probably seeing a bit of an impact to my credit score. But as I get to November of 25, I'll probably see some incremental improvement in my score. As I move into 2026, my score should probably go up a little bit further. So, that's kind of a guideline for how long they'll stay with your credit report. But again, the most recent 12 to 24 months is the most important. Let's take a quick look at the mortgage score calculation and how it's weighted based upon different factors within your credit score. So the first is length of credit. How long have I had credit? So the longer, the more mature my credit file is, potentially the higher my credit score could be. So if I have a client that's had credit for 6 months versus 6 years, generally someone that's had credit for 6 years would probably have a higher credit score. Now that's 15% of the overall weighting in the credit score. Now we want to be careful that if we decide to maybe make balance transfers and then maybe end a relationship with a credit card issuer, because when you close out a credit card or revolving account, it actually pulls away all the history out of the credit profile, and it could potentially negatively impact your credit score, both from a length of credit perspective, but also potentially what credit utilization you have or credit availability you have to you. Now, the next component or weighting is how much credit am I trying to obtain? Am I trying to open up new accounts? Do I have hard inquiries on my credit score? That is 20% of the makeup of the mortgage score. So I really want to avoid opening up new accounts, especially in a 6 to 12 month span of time, because the more accounts that I'm opening up, the negative impact I could have to my score. Now, we talked really quickly about hard inquiries. So a hard inquiry is where a lender is accessing your credit because you're trying to obtain an account, right? That hard inquiry could potentially impact your credit score. Now, there are rules in credit scoring, especially when around auto financing and mortgage financing, that if I apply with a creditor within a 30-day window of time, I can do so with other creditors without impacting my score. So it allows me to do my shopping, if you will, and it's the equivalent of one credit inquiry hit to my score. Now, here with our team at APM, we do things a little bit different, especially when it comes to our consultations. We actually do a soft credit check when we work with clients for that initial consultation. The reason why I choose to do that is because our clients are on different cycles of time in terms of when they're going to buy, right? And so we want to give you the guidance and design a home buying plan for you without negatively impacting your score. So we always start with that soft credit score to help properly guide our clients. All right, now let's kind of moving along. We're going to look at amount owed in the credit weighting. We're looking specifically at credit utilization, taking a look at what do my revolving accounts look like in credit limits versus my credit balances. So if I have $10,000 in total available credit limits and I have $5,000 in active balances, right now I'm at 50% utilization of credit, right? Now, if I just recently added a new, trip on my credit card, so I paid for a $2,000 trip to Cabo, right? Now my balances have crept up to $7,000, so now I'm at 70% utilization. There's a pretty high probability once I see that credit balance increase on my credit report, it's probably going to negatively impact my credit score, because once we go over 50% utilization of credit card debt, I'm probably going to see some pullback in my credit score. So our coaching for clients is to try to first get below 50% utilization. We'll see a little bit of an incremental pickup in credit score, and then ideally start moving that to 30% utilization, and then try to get below 10% utilization, which would be kind of optimal, if you will. Now, here's one of my tips for our class tonight in managing credit card debt. If you can, when you look at your credit card statement, there should be two important dates. The due date, of course, when you make your payment, but also the statement date. Now, that statement date is the date when your activities from the previous 30 days have now ended. And now the credit card issuer is going to send out all your information out to the bureaus. So my tip for our class is, if you can try to pay off or pay down that account before the end of the statement close date, what you're going to do is you're going to get a much lower balance that reports out to the credit bureaus, improve your utilization of credit, and then therefore get a higher credit score. So if you're preparing for home ownership, let's try to whittle down those credit cards as best as possible. Now, we're going to help kind of coach you through that during a consultative process with us. So, when you apply with us in financing, it's not, we're going to be able to kind of help analyze your credit card debt and see how to kind of get it in an improved situation for your qualifying. But ultimately, a great way of managing credit card debt is to try to pay things down before the end of the statement date. Last thing is payment history. That's going to have a 35% weighting in the credit score. We're looking at, past delinquencies, and those delinquencies are rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. The more severe I'm on the end of the spectrum of lates, the bigger impact I'm going to have to my credit score. All right. All right, I'm going to take a quick pause before we talk about student loans. Any questions from our class so far on some of the content? Okay, now of course I know we had one question in the chat, which was the rent versus own calculator. We put the link to that in the in the chat. We're also going to include that in the presentation material that goes out to our audience tomorrow. Okay. Let's talk a little bit about student loans. I know it sounds like we're going to have reactivation, if you will, on student loan payments. And so we do have to kind of explore a little bit more about what the status is of your student loans in preparing for your home purchase, because it is part of the lending guidelines that we have to adhere to. There's different ways that we look at student loans. If you're currently in an active repayment program, and let's say it's an income-based repayment program, we can use the income-based repayment payment for your qualifying. So if I have $75,000 in student loan debt today, and I'm on a graduated payment plan or a savings plan at $250 per month, we can use that to calculate your payments today into your qualifying for your mortgage. Now, if I'm not in active repayment, let's say I'm still in forbearance or deferment because I'm back in school, then we do have to take a minimum amount in qualifying. So on an FHA loan, we have to take 0.5% of that $75,000 in debt as the qualifying payment, which would be $375 monthly. On a conventional loan, Fannie Mae loan, we take 1% of the balances or $750 in payment. So those are discussions we'll have with our clients as we build their home buying plans. But I just want to create some awareness around our around how we look at student loans, because certainly it does come into the conversations I have with clients that are facing student loan debt. So kind of the takeaway here in this section is if they are not in active repayment, forbearance, or deferment, we have to use those default calculations. But if you're in active repayment, we can use income-based repayment schedules. Now, the reason why we have to analyze student loan debt is because it's part of guidelines for lending programs. And so I want to kind of share with you at a high level look at what some of those loan programs might look like for you as you get closer towards home ownership. So let's kind of take a look at a few of these programs, and then we're going to do a quick dive into a mortgage insurance comparison to conventional loans versus FHA loans. So the first product is a conventional loan that has a minimum down payment of 3% for first-time buyers. It does have a minimum credit score of 620. Now that minimum down payment of 3% goes up to a loan amount of $806,500. Now, if I'm looking to finance more than $806,500, it goes into another space called a high balance loan. And so in different parts of the country, that high balance loan can go as high as $1.2 million. But anytime we stretch beyond $806,500 in total loan amount, that minimum down payment jumps from 3% down to 5% down. Now, when we think about the conventional loan, you guys may have heard about the terminology or the names out in the marketplace of Fannie Mae or Freddie Mac. So Fannie Mae and Freddie Mac have about 60% of all originations are done in that product suite. And so the conventional loan has a little bit of a misconception. Most clients, especially first-time buyers, think they need 20% down for a conventional loan, which really is not the case. It's a minimum down payment of 3%, especially for first-time buyers. Next product is the FHA loan. That is a government-insured loan. FHA stands for the Federal Housing Administration. Minimum down payment of 3.5%, minimum credit score of 580. And then the loan amounts for FHA vary based upon where you're going to purchase. So there's county limits set all across the country. So right here in Sacramento County, it's $763,600. Now the FHA loan and both the USDA loan is taking a little bit of a guideline change, unfortunately. So with some of the changes in the government lending space, FHA and USDAs now have a requirement that you must be a permanent resident to be able to access those products. So unfortunately, non-residents cannot access either one of these government insured products. It is still allowed under a conventional loan. So under Fannie Mae and Freddie Mac, non-residents can still participate on the conventional loan. So those are two of the changes on both government insured products. Now, the jumbo loan isn't going to be typical for some of our first-time buyers. It can be more of a second or third time buy situation, but it does have elevated down payments, 10 to 15% down, little higher credit score requirements. And it's generally for clients that need a little bit more buying power that stretch beyond maybe the conforming or the high balance loan limits for that particular market. The VA home loan is for veterans that are purchasing using the VA home loan. Great thing about the VA home loan, it has a zero down payment option. And for us at APM, we can do a zero down payment option all the way up to a $5 million loan. Probably not going to be in many of those types of purchases, but ultimately it allows a lot more flexibility for the veteran, has a minimum credit score of 620. And then for veterans that are any type of partial disability, generally the funding fee for the VA loan is waived, which for veterans that don't have any type of exemption from the funding fee, it's usually a 2.3% first-time user VA funding fee charge. Now that usually gets rolled into the total amount financed. The USDA product, like I mentioned, has some changes with eligibility around citizenship, but the USDA product is for clients that are looking to buy in more rural areas. So it's a zero down payment option, minimum credit score of 620. It can also be complemented with some first-time buyer programs, and the maximum loan amount will vary based upon the county, very similar to the FHA loan product. So it's designed for more rural areas, so you have to fit within the geography for a deemed rural area, but you also have income limits based upon your household size. So there's a wide variety of different products that are available to buyers. And so as I get a chance to meet with clients to design their home buying plan, we're going to figure out what the right match is for you based upon your goals and objectives with home ownership. Now, one of the things we're going to dive in closer to as part of those consultations is to talk a little bit about mortgage insurance, or PMI, which PMI stands for private mortgage insurance. And then on the government insured side, there's MIP, which is mortgage insurance premium. Now, PMI comes into place on a conventional loan when I put less than 20% down to purchase my home. PMI has a graduated scale on a conventional loan, so it's based upon my down payment, my credit score, and then how much I decide to finance. So the higher my credit score is, the more I put down, the lesser the cost of the premium is going to be. Now, if some of our class has already started their home search on Redfin or Zillow, whatever the case may be, if you've decided to use those calculator features, they don't necessarily calibrate to some of the features I just highlighted for you. So you might see that mortgage premium looking a lot higher than what it generally is when we think about those factors. Now, on a conventional loan, PMI has a cancellation option. So once I have 2 years achieved in my loan and 20 to 22% equity, I can apply to have my mortgage insurance canceled without having to refinance. So if we dive a little bit deeper into the conventional PMI scenario, let's take a loan amount of $450,000, someone that has a credit score of 740 and putting down 3%. My cost of private mortgage insurance is $183.75. So might be a little bit cheaper than what you've seen in your exploration online on different payment calculator tools. Now, one thing I wanted to point out about the why behind PMI and mortgage insurance. So essentially what mortgage insurance does is it protects the lender against default by the buyer. So if there was a economic hardship by the buyer and there was a defaulted situation, the lender would be protected against that default. Okay, so that's kind of the why behind PMI and MIP. Now, on the FHA side of things, MIP is a government insured loan, right? And there's two forms of mortgage insurance for an FHA loan. There's monthly mortgage insurance, which is 0.55% of the total loan amount. We divide that by 12 and come up with a dollar figure on a monthly basis. And then there's upfront mortgage insurance, which is 1.75% of the total loan amount. Now that 1.75% gets financed into the buyer's financing, so it's not an out-of-pocket expense, but it can elevate the cost of expenses for the financing. Now, with FHA loans, there is no cancellation option. So it can only be canceled by refinancing. So essentially, if I take out my FHA loan today and I'm looking to refinance in a couple of years, I would generally want to use my FHA loan to have my entry point to homeownership. And then when rates normalize, I would look to refinance to try to get to more of a conventional home loan product. Now, the FHA has two forms of mortgage insurance, like I mentioned. So there's the upfront MIP, which is $78.75. You can see in our example here. And then we have the monthly MIP, which is $206 per month. So there's clearly a difference from an expense perspective when we look at FHA versus conventional. But I will say, when we think about qualifying for our financing, the parameters around FHA can be a little bit more flexible in qualifying versus what we might see in conventional. So an example would be, maybe I had a late payment maybe a year ago on maybe my student loan payment. That might make conventional financing a little bit more challenging versus maybe an FHA loan a little bit easier. Or maybe I had a bankruptcy that was 3 years ago. Conventional would want to have a bankruptcy that's seasoned at least 4 years, whereas FHA would be 2 years. So, we're going to figure out what the right fit for you is in working with you on this path towards homeownership. But that at least gives you an idea of some, the characteristics that are involved in some of those different product types and how mortgage insurance can impact you in homeownership. Now, as we kind of move along in our discussion tonight, I want to talk a little bit about income for qualifying and kind of share with you some of the parameters, if you will, around different guidelines for income as you're preparing for homeownership. Now, I wanted to also include with you just some documentation requirements. So if you're thinking about looking at your options around homeownership, these are some of the general items that we'll ask for from a buyer that get sent over to us for review in anticipation of a consultation. Now, as we look closer at income, we're going to look at the last 2 years of income for qualifying. However, there is some kind of misconceptions in the marketplace that you have to have, 2 years on your job consistently, or maybe even 2 years in an industry to qualify for a mortgage, which just isn't the case. So as long as I can verify 2 years of work and or educational background, we can use that for qualifying purposes. So let's say, for example, I've only been on my job at the state for the last month because I just got hired on after graduation. I can still use my state of California income to qualify me for my mortgage, even though I've only been on the job for 1 month, because now we can use the supporting education to make up the full 2 years. So in some scenarios, we can also have clients that are just, getting ready to graduate here. We know graduation just took place this past week. Maybe they have their new job that they're starting on July 1. If someone has an executed offer letter, we can use that for qualifying on a home today. Okay. Now, what we do look at from the 2-year perspective is scenarios where we have clients that either have their own business. We have to show 2 years of tax filing in order to qualify that income. So that requires 2 years. If we have dual employment, so sometimes we see this in the medical field where maybe I'm working for multiple clinics. I have to show that I've been working in both areas or both locations for 2 years simultaneously in order to use both sources of qualifying income. Okay. Also, if I have a 40-hour work week job, but let's say I maybe drive for Uber or Lyft on the weekends, then we have to show that I can demonstrate being able to work for both a 40-hour work week job and drive for Uber or Lyft simultaneously for 2 years at a time. Okay. So the other kind of scenarios that maybe come up in conversations with clients are other sources of income. So if I have a side business, for example, maybe I'm selling, goods on eBay, for example, that is considered 1099 income as self-employed. So in that scenario, it's very similar to Uber or Lyft income. I do have to demonstrate a 2-year history. Now, if I have a partner that supplements and provides income and pays expenses in the household, I can't include that partner's income into the financial calculations for homeownership unless my partner is going to be part of the application. Okay. The other thing that comes up often is, room rents that I receive. So if I'm renting a 3-bedroom place in Midtown and I'm renting out rooms at $1,000 per unit, I can't include that $2,000 in room rents into the equation because it doesn't carry forth with me into my new home purchase. Okay. So those are some of the situations or scenarios, I should say, that come up in my conversations with clients. But ultimately, we're going to kind of sort through income and what can be used as we design your home buying options. Now, there is a calculation that we look at in determining eligibility for clients. We call that debt to income ratio. You may have heard about it. Really super simple calculation. It ultimately looks at your expenses versus your income in qualifying for a mortgage. Now, we're looking at the pre-tax income, then we're taking in consideration expenses like personal loans, credit card debt, car loans, as well as what the new expected housing expense is going to be, which would include principal and interest, the taxes for that home, homeowner's insurance, mortgage insurance. Maybe you're deciding to buy a condo or maybe a townhouse, which would have an additional expense like HOA expenses. So we have kind of example on screen here. So if we have someone that has, let's say, $3,000 in expenses between their car payment and the new house payment, and they're making $8,500 a month, that client would be at roughly about a 35.3% debt to income ratio. So we're saying that 35% of their gross or pre-tax income is being consumed by those expenses. Now, the guidelines require us not to exceed 45 to as high as, believe it or not, 50%. But, the ideal kind of target area would be somewhere around 33 to 36%. I would consider that more of a comfort zone, if you will, when it comes to the right debt to income ratio. But, what's really important for me when I work with our clients is affordability, right? And so we're going to have those conversations with our clients because maybe the $2,500 mortgage payment feels affordable for us and we can make that work versus I can qualify for a $4,500 mortgage payment that maybe not feel so good, right? So we want to get ourselves into a range of affordability and sustainability around home ownership. Before we move off of income, I got a good question that actually I went through with a client earlier today in our discussions, which is, can lenders, banks consider RSUs, which would be restricted shares, in qualifying towards a mortgage? So you can use vested restricted shares in qualifying. And so what we do is, and I went through a calculation with a client earlier today, we take the 200-day moving average of your publicly traded stock, and then we take that and whatever that number is, so let's say it's trading at $20 a share, times the number of shares that are vested, and then we divide that by 24 to come up with an income figure. So the 200-day moving average, what your number of shares vested are, and then divided by 24 months, that can translate into income. So yeah, thanks for that question. That's a good one. So let's talk a little bit about the last component to homeownership, which is probably one of the biggest ones, that is around savings for homeownership or the down payment, right? When I think about homeownership for buyers, there's usually two challenges. It could be around credit, just because I'm a little bit more overextended right now, or maybe some legacy issues around my credit score. But more than likely, it's going to be around savings for homeownership. So I want to first point out some of the documents that generally we look to validate around savings that you've already have or resources. But I want to talk a little bit about savings plan, and then we'll kind of transition into first-time buyer programs, which is really important here for us in California. And so acceptable sources of down payment look like this: checking and savings accounts, 401ks, 403bs are all allowed. Brokerage accounts can be allowed. I would encourage you, before you get into investment vehicles to fund your home ownership, I would say talk to your financial or tax advisor, make sure you're not creating a tax liability or, hurting your performance of that investment. Now, gift funds can also be used in home ownership. That's where a family member is gifting you funds towards your home purchase, and that's completely allowed. Other assets outside of gift funds generally need to be seasoned 60 days, but gift funds do not. We just have to paper trail how those funds are arriving to you. Okay. Now, there's usually a gift letter that is completed by the donor, and then those funds are either transferred to you or to the escrow company who's handling your home purchase. Now, when we look at savings for homeownership, that is a challenge for first-time buyers. And so we've kind of come up with a really simple savings plan that you can implement today on that path towards your goals of this major financial decision. And if you were to think about your current rental situation, so let's say you're renting for $2,000 a month, but you feel like you can afford, on a monthly housing perspective, $3,500 a month as a mortgage, right? So you have about a $1,500 gap today in where you're paying today versus what you think you can pay. What I would encourage our client to do is, let's start paying like we're making a mortgage payment on the first of the month today, right? So when I pay my $2,000 rental payment, I'm taking that $1,500 variance, which is theoretically what I would have to put into a mortgage, and put into a savings account on a monthly basis. And it does a couple things. Most importantly, it's growing your savings, right? So after 6 months, I have $9,000 accrued in savings. After a year, I have $18,000 in savings. But it also creates the discipline of making that mortgage payment, so it's not such a payment shock for myself when I move from renting to owning a home and all the expenses that come along with it. So we would encourage you to think about the implementation of a savings plan similar to that, because that can really help continue to stack up those reserves that you'll need in that path to homeownership. Now, we're going to talk a little bit about assistance programs. Before I do, I want to hit one of our questions that came in, which is, could you expand a little bit more on using a 401k to pay towards your down payment? Is there any penalties associated with withdrawal? So first of all, if you do decide to use a 401k, I would encourage you to talk to your plan administrator, because every plan has different stipulations. But generally speaking, when you take out a 401k loan, or access your 401k, if you take it out as a loan, there should not be any penalties for that. A 401k loan, you're paying interest to yourself, but you're also taking that balance, or whatever amount of funds you extract from the 401k, you're taking it out of the market, so you do lose the appreciation. So for example, if I have a $50,000 401k balance right now, and I'm taking $25,000 out to fund my home purchase, that $25,000 generally is probably going to come out of the market. So you're not going to get that appreciation if the stock market goes up or whatever, but you are taking a loan against your balance. So your employer will set up a repayment schedule through your paycheck generally on a 401k loan. Now, if you distribute from your 401k loan, you want to be careful. That could create a tax liability. So before you make any moves on something like that, definitely talk to a tax or financial advisor. Now, let's talk a little bit about assistance programs. So I know most of our audience is here in California. Certainly, if you're checking out tonight's class and you're outside of California, we can explore other first-time buyer programs. But I do think most of us are here locally in the state. So let's talk a little bit about CalHFA. CalHFA stands for the California Housing Finance Agency. And the agency is designed to support low to moderate income households in homeownership. Our team here at APM happens to be the #1 provider of this product all across the state. I really love and support this product. We've got a chance to develop products with CalHFA, some of which you may have heard, like the Dream for All product, which is not currently active. It's fully funded, but we may see that product reemerge at some point, but today is not currently have funding. But I want to spend some time looking at some of the assistance programs that are available to you as first-time buyers that can make homeownership much more of a closer goal for you. And so let's talk a little bit about a few of these. So on a conventional loan, you can get up to 3% of your sales price in assistance. It's called the MyHome Assistance Program. It provides you a low interest rate loan at 1% to help fund your down payment. So that's 3% to meet the minimum requirements for a conventional loan. For an FHA loan, it's 3.5% of your purchase price, which coincides with the minimum down payment for an FHA loan. It is a 1% simple interest rate loan that the state's providing to you that does not have monthly payments. In fact, you don't have to pay it back until you either sell your home or if you decide to refinance in the future. So when we think about homeownership, this could supplement my down payment requirement. So all I would essentially have to pay out of pocket is my closing costs and my prepaids for homeownership. Now, there's another product that we just introduced 2 months ago called MyAccess, which provides up to 2.5% of my loan amount in additional resources. It is also a 1% simple interest rate loan and deferred payment, so not requiring repayment until we sell or refinance. And the MyAccess program just ultimately helps reduce that out-of-pocket expense. And then the next product is a ZIP assistance program. That stands for the Zero Interest Rate Program. It is a 2% of your loan amount assistance program, but it's 0%. Now, the difference between these two programs, MyHome is going to give us an opportunity of one of the lower rate options on the first mortgage with CalHFA. However, when we add on MyAccess, we'll get an elevation in interest rate. And the ZIP program is different from MyAccess. It does coincide with MyHome, but it takes that interest rate even higher on the first mortgage. So for most of our clients, since we've introduced MyAccess, we're generally going to couple together the MyHome Assistance Program with MyAccess. Now, if our clients can afford to put closing costs out of pocket, we really encourage to first look at the MyHome product because it will generally give us the lowest first mortgage interest rate. So I'm going to give you a scenario in just a second, just so you can get a visualization of like what does it look like to apply or implement CalHFA into your home buying plan. Now, there are other programs available like the Pathway DPA product, which is the APM product. It will support us with 3.5% to 5% of our loan amount for assistance on an FHA loan. There's also GSFA, which locally we see a little bit of that. GSFA stands for the Golden State Finance Authority, has similar benefits to CalHFA. However, the assistance programs do require, for most buyers, active repayments on a monthly payment for the assistance. So I would consider it to be a lesser product from CalHFA because CalHFA is going to have a 1% repayment on the assistance, whereas GSFA, you're generally repaying back the assistance that you get at the same level of interest rate that you would get on the first mortgage, and it's paid monthly. And then Fannie Mae and Freddie Mac do have some low-income housing closing cost assistance programs that can credit you up to $1,500 towards reducing your closing costs using Fannie Mae or Freddie Mac. All right. Let me show you really quickly about a calculation for CalHFA. We've used the 450 sales price in other examples, but if you had a 450,000 sales price and you supplemented, let me kind of back up just a second. Let's first of all look at it just from a traditional standpoint. So if we were to traditionally buy with a conventional product, we need our 3% savings plus our estimated closing costs, which should be somewhere between 2 to 3% of the sales price. So generally speaking, on a conventional loan, I would probably need somewhere in savings around $22,000 to $27,000. Okay, so that's what my baseline would be. Now, if I incorporate CalHFA MyHome Assistance into the equation, now I have the 3% assistance to cover that $13,500 down payment requirement. And then if I need additional resources, I can tap into MyAccess, which would give me another 2.5% of my loan amount. And so theoretically, I do have in resources available to me up to $24,750 to help lessen the burden of that cash to close figure. So, that's where we kind of implement programs like this based upon buyer need to help lower that cash expectancy, to help, like I said, make homeownership that much more of a near-term goal for our clients. Now, I had a question that popped in the chat, which I'm going to answer in just a second, because there are income limits for these programs. They're up to 150% of the median income for the market that you're going to buy in. I'll kind of showcase those income limits in just a second. This is some of the underwriting requirements or borrower eligibility for CalHFA. You have a minimum credit score of 640 for the FHA product, 680 for a conventional loan. Now, if you're considered low-income housing, which means I make less than 80% of the median income, minimum credit score of 660, debt to income ratio that we talked about earlier tonight, you can see on screen. Now, the income qualifications are a little bit different on CalHFA because it's based upon applicant size, not household size. And that's a lot different than other first-time buyer programs. And how we define a first-time buyer is someone that hasn't owned a house in the last 3 years as their primary residence. So I'll give you an example. I have a client in Southern California that owns 2 rental properties in Texas, hasn't lived in those properties in the last 3 years, but they're going to purchase in California as their primary residence. They are still considered a first-time buyer because they haven't owned in any of those or lived in any of those properties that they owned in the last 3 years. Now, this is eligible for any 1-unit property, so single-family homes. You can even buy new construction with these products. Condos, townhouses, even below-market home communities can be eligible for these types of products, and manufactured homes. But the manufactured homes have to be on land that is owned. So they can't be like in a manufactured home park or mobile home park. Here's some of the income limits for the greater, Sacramento area. So if you're joining us outside of this general area, we can put the income limits in the chat for you to check out. But this is generally what we see here locally. Again, it's based upon 150% of the median income. So if I have a situation where my partner and I both have income in the household, let's say I make $150,000 and my partner makes $100,000. If I want to apply solely just off my income, I can do that and still stay within the $225,000 income limit here in Sacramento County. All right. I know we're getting close to the top of the hour. Thanks for everyone kind of hanging in there. I do want to walk us through the buying process because I think it's really important to understand what comes next after our discussion tonight. And what would come next, if you're interested in connecting with me for a consultation, I would love to be able to meet with you for a free 30-minute consultation to help design a path towards homeownership for you. Now, what comes out of that consultation is what we call as a pre-approval. Now, whether you want to buy in 2025 or maybe in the next 2 or 3 years, I love meeting with our clients and our communities just to help provide a guideline for homeownership. So even though you meet with us for a consultation today, doesn't mean you have to buy right away, but we want to give you all the tools and resources to be able to act on that whenever it makes sense for you financially. Now, a pre-approval means that you now have eligibility to purchase. It's usually good for 60 days, but that can be recertified at any time. So your application, once you apply with us, stays live for 2 years. So, I have clients that have been looking since 2023. Their application is still active and we're always updating their pre-approvals as they go through, which is the next milestone is the home search. So that home search is generally the longest phase of the process because it may take you 2 weeks to find a house. It may take 2 months. It may take 2 years, right? And so the house hunting is a very fluid milestone in the process. Now, it generally starts online and then it eventually will be in person. We always encourage you to talk with a local realtor to help guide you in your home search. Now, being that we're based out of Sacramento, we are nationwide, but we have a lot of great resources here locally in California and Sacramento through our preferred realtor network, trained realtors that are specialists in first-time buyers. So if you ever want us to connect you with a realtor in your home search, we can certainly do that. Now, as you discover different properties that fit your criteria and maybe you kind of target one property that you love and you write an offer to that seller and the seller accepts your offer, that moves you to the next milestone, which is step 3. That means you're now entering escrow. And at that stage, you now have a ratified contract with the seller. Now, we've had a few of those transactions occur today with our clients. And so I call those clients the same day and say, hey, congratulations, your offer has been now accepted. Let's talk a little bit about the next steps from a financing perspective. And then we meet with all of our clients for a follow-up video session just to kind of reaffirm all the details from the earlier consultation we did with the pre-approval. We talk about the status of interest rates, what the framework of your financing looks like in terms of payment, cash out of pocket, expected closing costs that you have in your agreement with this seller, all those really important things during the follow-up video session. And so that also kind of starts the lending process, which includes getting the home appraised, working on your loan approval activities, all those things we do kind of behind the scenes. Now, One of your action items as a buyer is within the first couple of days is to make your earnest money deposit for the transaction. That earnest money deposit is usually 1 to 2% of your total sales price, but that deposit gets held in escrow while you go through some of the activities as part of your contract. There are timelines that make your contract contingent upon these items, which include getting your house appraised to make sure the value supports the purchase price, getting your house inspected to make sure that everything fits what you expect in the condition of this house, and then of course getting your loan approved. Now that generally happens in the first 17 days of your contract period. Now those contingencies can change a little bit depending on how your contract is structured. At times it can be short as 17 days. The baseline contract period is usually 17 days in a real estate contract. Now, as we move through the process, we have the processing and the underwriting of the loan, which are some of the administrative features like verifying your employment, verifying assets, and we're getting everything ultimately kind of put together for the underwriting review of your loan. And that happens at step 5. An underwriter reviews those income and assets, the credit, make sure the product type is structured correctly. That loan approval then gets issued at step 5. That also takes us about 2 to 3 weeks in the process. And now we're preparing to finalize your contingencies. So if everything checks out with your appraisal, your loan approval, you feel good about your inspections, then you can sign off on your contingencies as part of your contract. But beware though, when you sign off on your contingencies, that tells the seller that you're kind of all in on the transaction. And now your deposit, which was protected earlier in the contingencies, is now part of the transaction. So now you're kind of finalizing the last steps in the process. So it basically tells the seller that you're ready to move to the closing process. Now, as a lender, we're going to be delivering disclosures to you electronically, which includes your initial disclosures. You get revised disclosures once your interest rate is locked, because interest rates do vary over the course of the transaction. So once we lock in your interest rate, then you get another set of disclosures. And then finally, you get your final closing disclosure at step 5, which essentially gives you a 3-day cooling off period before we get to the very final closing of the loan phase, which is step 6. And that's where we're kind of getting to the finish line. You do have to eventually sign final loan documents at this stage in person with a public notary. That's still a little bit of the old school process in lending or buying a home, but that happens at step 6. You also deliver your final closing numbers or closing costs at that time. So whatever your out-of-pocket expenses, that is delivered now at step 6. Generally, that's through a wire. And then as your lender, we're going to wire in the final funds for your financing. That money gets reconciled by an escrow team to ensure you're participating with what you're supposed to as a buyer and the seller's receiving the proceeds they expect. Once that money gets all balanced out, then documents get recorded with the county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the loan. And after that all gets transacted, then we get a chance to celebrate with you, because now you become the owner of your home. And it's such a great day of celebration. That's my favorite call of the day. I get a chance to make those calls a couple times a day just to congratulate you and say, hey, you did it. Now you're officially a homeowner. You attended a class 6 months ago and now you're a homeowner. It is truly a celebration. But our relationship doesn't end there, because we have what we call our aftercare program. So after you become a homeowner, maybe you're considering refinancing, you want to lower that monthly payment. We're going to be putting you in our rate watch system to make sure we hit your target rate to refinance whenever that time comes. We also provide you tools like our HomeBot system to measure what's happening with appreciation rates on your home. And we're always checking in annually with our clients, because let's face it, things change financially for our clients all the time. We want to make sure that we're a partner, not just for buying your first home, but as the seasons of your finances change, we want to make sure we're here as a resource. Now, as we're actually wrapping up tonight's class, I want to just point out to you our next steps. So if you're thinking a little bit about getting connected with us for your free, no obligation consultation, I would love to meet with you for one of those 30-minute sessions. Here's a little bit more of how to get started in the process. It does start with an online application. We only do a soft credit check, and then you'll upload some of the required documents, and then we meet up on video just to figure out, like, what does the design of home buying look like for you? Like I said, whether you're buying this year, 2 years from now, 2 months from now, it doesn't make a difference. We want to make sure that we're a partner for you on that journey. Now, if you do have some follow-up questions after tonight's class, you can schedule an introductory call. You can do that all through our scheduling system, which you can find here. And of course, it'll be part of the presentation material. Here's what our consultation looks like. Again, it's a free obligation opportunity for you to get connected with us and design, where do I want to buy? What's my budget need to look like? What assistance resources can really match up good for me? And what do those goals and objectives really need to look like for me in homeownership? We get a chance to do that throughout our course of our day. And that's a big part of kind of designing this path towards homeownership for you. Last thing I want to point out to you as we get wrapped up tonight is our mobile resources. So you can start the process via mobile. You can also take advantage of some of the calculator features within our mobile app. Also get push notifications. So as you're moving through the process, you can be notified all via mobile. So really great tool, especially the calculator function gets used quite a bit by our clients. Last thing I want to spotlight again for you, with our partnership with Sac State Alum and Athletics, we also discount our services by $750 to create just better affordability for you in your pursuit of homeownership. And of course, you have access to our online classes that we'll teach. We teach over almost 60 classes like this throughout the year. So, if you do want to tune back into one of our future classes, you're more than welcome to get connected for those classes. In fact, if you want to share some of this information with friends, family, and coworkers that think might really enjoy content like this, they're free to attend any one of these classes. We also have other partnerships, as you can see, across the country. Of course, Sac State locally is our favorite partnership that we get a chance to work with throughout the year. Here's all my contact information you can see here. You can reach me at any time. Feel free to message me if you have any follow-up questions after tonight's class. And then, if you want to kind of check out some of our other video content or kind of see what we're doing on our socials, we try to put good content out in our social channels to create more awareness around homeownership. So you can follow us at JMeda Mortgage. All right. So that kind of takes us to the end of class. I appreciate I know we're 6 minutes over our time here. Thank you so much for being a part of our class. I am going to stick around for some questions. So if you do have some questions, please feel to drop those into the Q&A or the chat feature. I'll definitely answer those before we get out of here. Thank you for the positive feedback in the Q&A and chat. I appreciate it. And thank you so much for being a part of this class. All right. You're very welcome. Awesome. Thank you so much for the great feedback. I love it. Awesome. Okay. All right. I think we're good on questions. Stingers up, everyone. Have a wonderful evening, and we'll look forward to hopefully connecting with you all soon. Have a good night.